Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. The new French Prime Minister François Bayrou is set to meet with the National Rally's Marine Le Pen this morning. As efforts to form a new government get underway, Moody's becomes the latest credit agency to downgrade the nation's debt. In Germany, Chancellor Olaf Scholz is due to trigger a snap election as he prepares to submit a confidence vote that he's certain to lose. Plus, China's retail sales post a surprise slowdown in November, highlighting the need to boost demand in the world's second largest economy.
Meantime, quick check on these markets. We're waiting to see if that China story has a little bit of a read-through into futures. At the moment, it doesn't. Flat, basically, on Stoxx 50 futures and the FTSE 100 neck and neck on a percentage basis. Euro-dollar at 105. We've got the French story and the German story to think about, perhaps seeing a little bit more action when the bond market opens in just about 30 minutes' time. And then, of course, some weakness in the Chinese yuan, as Anna was saying. 728 on that currency pair. The countdown to the opening trade starts right now.
Nine days until Christmas. How many more surprises should we expect between now and then? We've had a few over the last few days, haven't we? France downgraded by Moody's. We didn't see that one coming, or should we have done? Manchester United, 2 late goals against City. That was certainly a surprise last night. What else do we get between now and the holidays? A hawkish Fed, potentially a dovish BOJ. Read the timorous article in the Wall Street Journal this morning. France, though, absolutely front and centre. We're going to watch Germany as well. But I think we should probably start with France this morning and figure out what is happening here. A new government? Do we need a lettuce? This is my question.
Yes, nice, obtuse reference to UK politics. Yes, maybe. We'll see if we can find a lettuce for you, Guy, and you can do your own experiment. François Bayrou, then, the new Prime Minister, from the centre, not from the left, and there had been an expectation that perhaps there'd be some reach out to try and divide the left. Could there still be some of that under this Prime Minister, though? Because we understand he's going to be meeting with Le Pen today, and we also understand he's going to be meeting with the Socialists in an attempt to try and sort of prize the left from the far left and make some progress there. But Moody's kind of summing things up, I suppose, with being the final credit rating agency to take them down a peg, now to AA3, and a lot of concern as to whether this government is going to be able to do anything on the budget that the last one couldn't do. And
stating a lot of what we already know, that the country's finances are weakened, that there doesn't seem to be a clear trajectory to positive territory when it comes to closing that deficit either. I think it's interesting, though, because if the special law does indeed get enacted in 2025, there has been a talk, including by Bloomberg Economics, that austerity baked into it actually could help narrow the deficit. Moody's is not on that train.
We'll get PMIs a little bit later on. We'll see what they have to say about what is happening within this French economy. That could be quite interesting. German PMIs also going to be coming out a little bit later. So I'm surprised that everybody's quite so excited about this confidence vote.
Right, over in Germany?
Yes.
Yes, absolutely. It's quite procedural.
Very procedural. We actually already know the date of the election, so I think we've pretty much got that one nailed down. Hasn't been used that many times, though, between 1949, which is interesting. The FT pointing that out this morning. What I'm really looking for later is the Merz press conference. What is he going to say? I think that could be interesting. What is he going to say about where the CDU, CSU ultimately go on really important things like the debt brake? And we're going to get the PMI data from Germany as well this morning.
Yeah, the debt brake making a lot of news over the weekend. We previously heard from Merz that he was open to the idea of reforming it. And now we have this draft from the CDU-CSU talking about keeping the debt brake. I then wonder if both are possible. But we'll see how the market interprets it, because you can keep it and reform it, perhaps, I don't know, at the margin.
Yeah, we're going to go through with it in some detail with a true expert, true German expert. But you can see it on your screen there. We're sticking with the basic laws debt brake. Today's debts are tomorrow's taxes. That, of course, as Anna was saying, was the statement. This is crucial because it's coming at a time when this feels like the make-or-break moment. There's no other way out, at least economists would suggest, than getting rid of the debt brake in terms of getting investment into Germany. Is there?
So does Trump force Germany to change tack? Does Trump force a Plaza 2.0? Do we see tariffs as the opening gambit in that? Germany runs a massive current account surplus. Yeah. Trump clearly is going to have an issue with that. How does he resolve that issue? In theory, you want to run some sort of a deficit if you're the government against that to sort of balance the two out. How does that work? There's all kinds of factors at play here in terms of the economics surrounding this. Germany desperately needs to invest. could Trump force Germany to invest? Is Trump the wild card in the German election?
Well, what does this do to the markets, though, is my question. I still don't have clarity on that, because every time you hear about the euro and this kind of French turmoil potentially impacting the euro, everyone says it's actually what's going to happen in Germany. And then you look at the story of German debt as the kind of safety of boons. But if you remove the debt brake, is it still that safe?
Right. And thinking about the way the markets have been trading this story, I was just catching up with Valerie before the programme, and I was noticing over the last couple of days, I mean, during the ECB press conference or since it, and then during Friday's session, we saw yields across Europe actually ticking higher, as if this wasn't French politics, it wasn't German politics. Was it the ECB? Well, no, maybe it's the Treasury, and maybe it's actually a US story, and it's US rates pulling things around. So, you know, yes, we can obsess over the European politics and what that does to European rates, but then you also have to remember to look across the Atlantic.
And maybe across the Pacific as well, which brings China into the equation, not just in terms of the effect on the United States and the rates there. Is China going to export the deflation or the disinflation, I'd say, that you're seeing in China? More importantly, is it going to have a little bit of a bleed through, at least in today's market, when it comes to that consumption data? That's showing another slowing. Maybe the fiscal stimulus not necessarily going to hit the data just yet, but it is something that could feed into the markets today.
2 months of, let's call it stimulus. Let's not call it stimulus.
Talking about it, at least.
Some sort of signs of some thinking about stimulus. Doesn't seem to be having much of an effect so far. I think is the broad takeaway from this. You need to go potentially much deeper. Is this a housing story or is this a social security story? How far is China prepared to go in resolving some of these issues? And again, it comes back to a similar story with Germany. Big current account surpluses, kind of how that money moves around the system, how Trump is going to react to that. I think all of these things are relevant for Germany as they are for China.
Yes, it's interesting to think about when Trump comes in and when you then want to play these cards that you might have. You mentioned it in the German context. It applies in the Chinese context, as we talked about before. Bloomberg Economics talking about a RRR cut due before the end of the year. So, you know, we might have that to think about as well as all of the other central bank items on our agenda this week.
Be interesting to see whether or not they manage the yuan as well. And how that's kind of the latest.
A lot of chatter. There was a story from other media last week, and then lots more over the weekend about what they're prepared to tolerate in terms of yuan weakness.
We're going to talk to Kamakshaya Trivedi, head of Global Foreign Exchange, Interest Rates and Emerging Market Strategy, about that very story in a few minutes' time. Helen Jewell's going to join us, EMEA CIO of Fundamental Equities of BlackRock, around the market open. And Kriti was hinting at this. Wolfgang Munchau, author of Kaputt, The End of the German Miracle, joining us in the second hour. You do not want to miss any of these conversations. I'm looking forward. I actually read a big chunk of this book this weekend. Makes interesting reading.
Good job. I read the whole book, just saying. I'm going to get his autograph later. I'm going to try to get his autograph later.
A-star student. What is it?
It's true. You're the jock, right?
I'm really not, believe me.
It's okay. There's plenty of room for nerds on this program, and Wolfgang will be joining us later. In addition to all the politics that we're keeping an eye on, it is, of course, Central Bank Week as well, which means we're getting plenty of data throughout the week. Global flash PMI is coming in today. As Guy said, we are waiting for the numbers out of France, out of Germany as well. On Tuesday, you get that UK employment data on Wednesday, excuse me. Oh, no, I'm going to say it's right. On Tuesday, the German IFO data. The coffee hasn't hit yet, as you can see. The ZEW survey as well. And on Wednesday, it is that UK CPI story, plus the FOMC rate decision. I'm going to go out on a limb here and say that all the bond market action may come in the later half of this week, with the UK data, the FOMC decision, the BOJ and the BOE, and then, of course, that PCE data on Friday.
Wow, that's a lot, isn't it?
Yeah.
You've both got your coffees, yeah?
Yeah, both got our coffees. We're ready for this week. Eyes down. We've got a lot of central bank meetings. We've got the Fed and the Riksbank are the two that are expected to cut. The Bank of England, the BOJ and the Norges Bank are expected to hold. I've committed that to memory. That's all I'm taking into the week with me.
It's probably a good starting point. Where does the surprise come from? So is the Fed hawkish?
China, RRR cut? I mean, that wasn't on the list.
No, not on the list. Hawkish Fed, maybe signalling it's not going to do anything else next year.
Yeah.
That's certainly, if you read the Tim Ross article in the Journal this morning, the hint is pretty strongly embedded within that may be the case. A lot of data, though, that we need to factor into our thinking as well. BOJ, dovish. If the BOJ is dovish, the market doesn't seem positioned for it. Very few shorts on at the moment around the yen, which is interesting given actually some of the commentary we've had from the BOJ over the last few days.
Yeah, they might be considering a hike, but they're not really. They're mulling it. They're thinking about it. They're not married to it.
But you push the hike out further and further and further.
Yeah,
and interesting on the Fed side of things, Goldman Sachs removing their expectation of a January cut. So there is an expectation that we get a cut this week.
Yep.
But then what do we see in January and onwards next year? They still think we'll get cuts in March, in June, in September. But there does seem to be, and it's interesting. They cite the jobs story, and they also cite tariff uncertainty when thinking about whether.
I'm going to cite Bitcoin. in this. Do you want to be cutting when animal spirits are this abundant in the United States economy? I think that's a question I doubt they're going to take in or on board, but it's a factor to think about. What else do you need to know this morning? Let's talk you through the stories that we're mentioning. As I say, Bitcoin hitting yet another record, its longest weekly winning streak since 2021. The move higher being fueled, of course, by President-elect Donald Trump's support for digital assets and optimism about the upcoming inclusion of MicroStrategy, which is, of course, a huge holder of the token in the Nasdaq 100. Saudi Arabia is condemning Israel's decision to expand its settlements in the Israeli-controlled Golan Heights. Saudi state news agency SPA reports the foreign ministry sees the moves as, quote, sabotaging Syria's chances to restore security and stability. And lawmakers in South Korea have voted in favour of impeaching President Yoon, this after he controversially declared martial law earlier this month. The country's constitutional court has started reviewing the case, with a preparatory hearing now set for December the 27th. The leader of South Korea's ruling People's Power Party leader is also stepping down, saying that he tried his best to try and find a better way for the country than impeachment, but, quote, failed in the end. The concern of the markets here is that this basically drags on, that this is not something that gets resolved quickly and neatly, but ends up being a 6-month, 9-month process. Yeah. And you basically got that overhang for Chinese assets during that process. Yeah, so South Korean assets, certainly focused on that. So we've got 180 days that this could take, and also some of the detail from our colleagues in Seoul, talking about how 3 of the 9 judges have not been appointed to the court that is deciding this, the Constitutional Court. And who gets to decide on the appointments? Well, the president has some say over those 3. And so we'll certainly wait to see how that plays out.
I'm wondering what the ripple effects for the broader international policy is, given that so much of this administration really saw changes in their defense policy, and that's something that has caught the attention of NATO and caught the attention, certainly, of the Biden administration. I'm sure will catch the attention of the Trump administration as well. And in that time frame, you're also going to see potentially them respond as well. I'm curious to see what that ripple effect looks like.
So many moving parts over the next few months.
Yeah.
Like, so many potential for surprises. We didn't see what was happening in South Korea coming. How many more of those kinds of events could be coming our way?
Right, yes, indeed. And in sticking with the Korea context, we know that President Trump was very active on that front in his last administration and had a lot of goals and ambitions to reset things. So we'll see whether this becomes an area of focus for him.
Yeah, I believe North Korea was a big sticking point in that last relationship.
Coming up on the programme, ECB President Christine Lagarde says more rate cuts are on the way. We will bring you more as she speaks this morning in Vilnius. Plus, strategists see another year of European stocks trailing the United States. We'll take a closer look at the outlook for equities in 2025. Up next, we're joined by Chris Beauchamp, Chief Market Analyst at IG Group. We'll go around the world with some of the themes we'll be throwing around this week. If you have any questions, if you want to get involved in any of these conversations, we're talking market strategy, FX, German politics, European geopolitics, all of that in the mix this morning. IB plus BBTV Go. That's the function to use on the Bloomberg terminal. This is Bloomberg.
.43 minutes to the market open this Monday morning, 9 days till Christmas. What should we be expecting for the rest of the week? Obviously, other than a little bit of Christmas shopping. Well, there's plenty of things happening. Central banks are plenty. Traders adjusting their positions. Ahead of that, we are looking, of course, at the Fed, the Bank of Japan, and, of course, let's not forget the Bank of England. Valerie Tetel has more details.
That's right, Guy. This could be the last liquid trading week of the year, and it is a packed week full of central banks. We have the Fed on Wednesday, and then on Thursday we have the Bank of Japan and the Bank of England. A lot of the attention is going to be on Wednesday's Federal Reserve. They're widely expected to reduce interest rates by a quarter point, but the devil is going to be in the details. They'll also be releasing their summary of economic projections, and within that, the assessment of how many cuts the U.S. economy needs next year. They previously penciled in 4. Just how much lower will they shift now? The Federal Reserve is meeting with a backdrop of a pretty decently weak Treasury market. Last week saw yields rise in the 10-year sector near 25 basis points, Guy. It was the worst week for Treasuries of 2024. It was a slow grind higher in those Treasury yields. Not a very clear catalyst for the weakness just with the backdrop of U.S. economic growth looking pretty stable, and we're still seeing a Fed cutting into that. What we also have to get through today before we get to these Federal Reserve decisions are the global flash PMIs coming out for Europe just across this morning. Remember, we saw a pretty decent disappointment in last month's figures. We saw this weakness in manufacturing going further into services. All three main composite indicators across France, Germany, and the Eurozone are in contraction and are expected to remain in contraction. But the market will be very much focused on those services number and just how much more weak they get from the manufacturing input.
Valerie, thank you very much indeed. So where do the surprises come from? We've already talked about some. We had the French downgrade Friday. United, 2 goals, late goals last night. That's a pretty big surprise. City lose again. Do we enjoy that moment? Anyway, let's talk about what else could happen this week. As we've just been hearing, you've got plenty of economic data and central banks to digest. Everybody seems to be on the confidence side of the boat. That side of the boat very full at the moment. The other side of the boat not so full. Should we be aware that there is another side of the boat? Chris Beauchamp, Chief Market Analyst at IG Group, joining us around the table. You feeling confident?
I'm still optimistic over the longer term. Anyway, but the short term is...
What does the short term mean?
Over the next sort of 3 or 4 months, right. I would be concerned. The turn of the year is always funny. People seem to come back from Christmas in a bit of a different mood. Maybe they're more cautious. And this is, I think, after, as you say, we've had months of gains in stocks, we've had flows into equities. Everyone still feels positioned for more growth. And that's just over the years has been when you should start to be slightly concerned in the short term that there could be a nasty surprise lurking in the works.
So what does 2025 look like for you?
Well, it should be another year of what we've seen, really. Not to say more of the same, but the factors that persist over the last 2 years, US growth versus weakness in Europe, should persist.
Hasn't something quite big changed in the form of a new president in the United States?
But this is where we focus so much on, what will a new president do for the economy, what's the impact of various presidents. But this is the US economy we're talking about here. The president has effects around the edges, but it doesn't drive the underlying economy. And that in itself is still in a very, very good place.
Yep.
Certainly when you compare to Europe. So, in one sense, it shouldn't make that much of a change. I think it's the mood music that goes with it, the regulatory possibilities maybe are more benign for business, but the overall sort of approach for the US economy remains exactly where it was, and investors continue, I think, to react to that.
Yeah, Chris, good morning. Is there some no, I won't
try
that word.
Coffee.
Yeah, more coffee needed. Is it incongruous? Let's go with that. That we have these records in stocks, but at the same time, you know, gold's not doing too badly, the dollar's not doing too badly, a lot of money goes into defence stocks, as if we are very aware of the geopolitical risks and realities in many parts of the world, but that doesn't dent appetite for stocks. Is that's okay these days, is it? We accept that's
well,
the case.
It seems to be the case. Certainly the curious things about the last year is just the way the markets have really shrugged off the concerns that are building, that we're looking at the situation in Ukraine. We are potentially, if you go back to Guy's point about the change of president, seeing a different security world, which calls into a lot of question about the assumptions that Europe, I think, works on politically. And then, of course, you have China as well. So the geopolitical tensions are certainly there. It's just the way that markets, not oblivious, but are prepared to look past maybe this and assume that we're not going to see a major flashpoint in 2025 because the situation, the drivers just aren't there, if you like. China has seen Russia's invasion of Ukraine, and they indeed are acting, if you like, as a brake on the Russians in many ways. But they've seen how it's gone in Ukraine, and they understand that if they were to consider anything with Taiwan, it's going to be much harder than anticipated. Yeah,
that's an interesting perspective. Bringing things much more sort of close in terms of time. This week, we've been talking about all the big central bank events that are on the agenda, and we're wondering where we could be surprised. Which of the risks do you think is kind of underpriced? We're expecting the Fed to cut, they're expecting to cut, others to hold. We may get some further stimulus out of China, a triple R cut perhaps. Is there anything else that you think we need to keep on our radar as we get towards the end of this year?
Well, I suppose you have to worry about what the BOE will say, really, because that is where the situation continues to worsen. I think if you align them certainly more with the European camp where things are continuing to look poor, and I think the risk is that the BOE has to move faster in 2025, almost, to respond to an economy that is clearly not moving in the right direction. So I think that's your risk for the week, is that suddenly Bailey has to begin to hint that the moves they take at the moment are going to have to be stepped up next year.
OK, that's interesting, because I think actually the Bank of England is expecting 4 cuts in 2025 in some of the analysis they've given. The market only 3, but you think that the...
I think they may have to go a bit sharper towards year-end, really. We've had the poor GDP data from the UK on Friday. We know how the economy is beginning to respond to the budget, and that, I think, will continue to pile the pressure onto them, really.
Is policy divergence a problem? If you start to see the United States just hold their policy rate, you see a more dovish take out of the ECB. We're already seeing that this morning from Christine Lagarde, expected to. Perhaps more easing from China as well. Is that policy divergence a problem, or does that just make it easier to trade?
I think it shouldn't be a problem. I think it's more a welcome reflection for investors that central banks are seeing things, they're not simply a uniform block anymore. There's far more sustained weakness in other parts of the global economy, and central banks respond to that. I think what they'd like to see is China actually providing the concrete stimulus that they've been promising and talking about, rather than simply issuing declarations to that point. I think what they'd like to see from the ECB is more of that. So I don't think it's a problem, per se.
When it comes to the France-Germany story, this morning we're already getting that yield gap widening by about 2 basis points off of course, the Moody's move on Friday, the surprise cut to their outlook, plus, of course, the meeting coming from the new Prime Minister with Le Pen as well. What is the ceiling for that yield gap?
I think we'd like to see the questions with the yield gap is reflection of the fact that France is in a very different position in terms of the stability of its government. And I think the ceiling is something that would continue to see it, I think, widen, really, I think is the concern. But
if it widens at a slow and steady pace, which it seems to be, at a snail pace, really, but widening nonetheless, is that still a problem?
No, I think investors can live with that, more or less. Is that things that happen in a fairly steady fashion, I think, are the most important thing, really. If it moves too quickly, that's when people
What does too quickly look like?
I think it looks more dramatically over sort of 2 or 3 weeks, really, in terms of the pace, if you like.
Does Europe underperform next year, more broadly, the United States?
Every year somebody's had to write the "Is it time for European stocks out?"
We've got a piece on the terminal this morning talking about whether or not we've hit peak pessimism. Have we?
I think we partially have in terms of, for Europe. I think it doesn't mean they outperform, I think, but they are looking at plenty of opportunities, particularly, say, France, which has done a lot more poorly than Germany this year.
If the United States, say the US equities fell out of bed, are European equities a safe haven, or do they fall even further out of bed?
They go even further. I think that's the problem for European investors. OK, this looks good value, but if the US sneezes, everyone else catches a cold, and even more so, really. And I think that's the major problem for European investors. There is no safe haven in European stocks, particularly because they know that the read across from a US recession, if one were to arrive, would be significant in Europe.
And if we're thinking about things that continue from this year into next, do we see that focus on the diversification trade in the US, Chris? Is that still going to be the obsession that people are looking for, but that doesn't quite deliver?
Yes, that's the other one, isn't it? Oh, can this market continue to move higher without the participation of most stocks? Now, this year, most US stocks have underperformed the index. Yes. But you don't see any reason for that to change, particularly.
But the last 2 weeks, it's been the mega caps that have driven all of the gains.
Yes.
I think if you look at the S&P, the bulk of them over the last 2 weeks, when we've seen this kind of really nice rally, have been negative.
I think that's
only a few positives.
Yeah, that's year-end exuberance. I think we shouldn't assume that's the condition that will persist for much longer into next year. I think really it's December, volumes are thinning, people are going with what they know works towards the year-end. Don't think too hard about this while it's December.
All right, Chris Beauchamp, Chief Market Analyst at IG Group, joining us around the table this morning. I think we threw a little bit of everything at you. We'll do a little bit more of that with our next guest. Coming up on the program, we'll look ahead to this week's central bank decisions. Kamakshya Trivedi, head of global FX interest rates and EM strategy over at Goldman Sachs, joins us around the table. In the meantime, we do monitor these bond markets, already seeing a 2 basis point move to the upside in terms of the yield spread between French debt and German debt. We'll see if that continues or even is reflected in Eurodollar. Eurodollar at 105.18 at the moment. Stick with us with that conversation next. This is Bloomberg.
Welcome back to the opening trade. 30 minutes until we get that opening trade for European equities. And let's have a look at the futures picture with that in mind. A little bit of movement expected at the start of trade to the downside. US futures look slightly positive, but really not by much. Friday's session, we didn't see a whole lot of movement overall in terms of equities, but a lot of focus on what's going on in bond markets. We saw some selling in bonds during Thursday, Friday in Europe and in the United States, and those yields going higher. Interesting, we're now above 3% on the French 10-year yield as a result of Friday's move. moves. But it isn't just a French story. We've also got other factors in the mix as well. Now, France's new Prime Minister, François Bayrou, will meet the far-right leader Marine Le Pen today, kicking off an effort to form a government that can push a budget through a divided parliament. Eleonora Mavroidi from Bloomberg Economics joins us now from Paris. Eleonora, what does that mean for the deficit next year? Talk us through your thinking.
It seems that, well, the new Prime Minister Bayrou will face the same fragmented and polarized parliament as his predecessor, and that would probably limit his ability to pass any big fiscal plans next year. So in the meantime, the parliament will likely approve a special law to allow the state to finance itself, and we got more information about this special law last week. There are two pieces of information. One is that the State Council published an opinion that income taxes should not be indexed. And second, the government has confirmed that the pension indexation would start by reportedly January, as opposed to a delayed indexation under Barnier's plan. So we estimate that this is likely to be consistent with meaningful austerity, but deficit will still remain wide next year at around 5.4% of GDP. That will be down from 6.1% in 2024. And higher than the 5% target of Barnier that failed to pass.
Good morning, it's Guy. So we got this unscheduled Moody's downgrade Friday. What impact does that have?
So overall, we don't see that the prolonged political gridlock would bring some massive economic turmoil. Because the government will be able to extend most likely the 2024 budget, but the long-term forecast for fiscal sustainability looks precarious. What we learned in the past weeks is that the parliament is so divided that it's hard for the next government to deliver on the fiscal consolidation plans under the medium-term plan that was approved by the EU, and that would have put the French debt on a downward path. So. If the government fails to consolidate, starting from now, that could put debt on a steep upward trend that exceeding 120% by 2027. And even if we assume that it simply returns to pre-pandemic norms or budgets, we estimate that would not be enough to stabilize the debt to GDP ratio because borrowing costs have been increasing. So, not surprised, markets have been jittery, specifically around the collapse of Barnier's government, and higher spreads are likely to weigh on economic growth next year. And we estimate if spreads were to remain 35 basis points wider throughout 2025, that could put a 0.5% drag on growth next year. So, wider spreads, slower growth, this is a bad combination for public finances. And the risk is that spreads would widen further in the future.
Eleonora Mavroidi from Bloomberg Economics walking us through what that new French budget may actually look like. We thank you so much. Let's get a little bit more on that market impact. Eleonora was hinting at it there. Let's get a little bit more perspective. Kamakshya Trivedi, head of global foreign exchange interest rates and emerging market strategy over at Goldman Sachs, joins us around the table. Let's kick it off with that euro conversation, the currency story. She kind of mentioned it there a little bit. What matters more for the euro story? Is it France getting its finances under control, or is it perhaps being overshadowed by the possibility of a German debt brake being removed? What matters more?
I think they both matter, obviously. I think the domestic picture in Europe matters. I think it's generally acknowledged to be cyclically weak, and I don't see either of those two impulses you mentioned really breaking us out of things and into a kind of much better, stronger cyclical trajectory. We don't expect a huge fiscal impulse out of Germany, and it's going to be some time before France gets its finances under control so that there can be a fiscal channel of supportive growth in the euro area. Ultimately, we come back to this. The ECB and its path to lower rates, I think, is one of the primary channels of transmission in the euro area, and that weighs on the euro. That's a weaker euro story. It's why we expect a weakness in the euro going forward.
But there's a dislocation here, isn't there, in that the euro used to very closely track that OAT-Bund spread, and it hasn't lately. Is that something that snaps back into focus?
I think if you start to see that spread start to, migrate into other parts of the peripheral pricing, so if this becomes more than just about France's budgetary drama and into something, more concern around the European situation, the peripheral situation, that's when it starts to typically affect the euro and the currency. Until that point, it's probably going to remain something that affects French spreads, French assets more generally, but probably the euro itself is probably going to remain a little bit more range-bound.
Kamasha, let's go around the world, because this is links actually to the European conversation. Going to China next, a lot of focus, of course, on Chinese growth from a European perspective. We heard from China over recent days talking about vigorously countering external impacts. This seemed to be code for preparedness to weaken the currency in 2025. Talk us through your expectations as to what that means. I mean, this is a managed currency, so how weak are we talking here for the yuan? And how much do they want to actually wait and see what Trump means before they give the full answer to that?
I think that's a very good point. I think they will wait to see what kind of trade policy we see, what kind of tariffs, what industries, etc. But I think ultimately it is a managed currency, and I think they will choose to let the yuan weaken. I do think it's a mistake to look back at the 2018 episodes and just calibrate the extent of the tariff increases you're going to get. We expect a 20 percentage point increase in the average effective tariff rate on China, and then just work out what that would translate into the dollar CNY rate, because I think they're probably not going to move with the same degree of sensitivity. They have more tools. They want to do more fiscal. They actually do want to see a rotation of demand away from the external side towards the domestic side. But I think all that said, they will let the CNY weaken. We're expecting something like 7.4 to 7.5 over the next 6 to 12 months. I think that's the kind of level you're going to get. That is a meaningful weakening. It will have a spillover into things like the euro that we were just talking about. But I think CNY, they will choose to let it move to some extent to offset the impact of that trade uncertainty.
So weaker CNY, stronger dollar in that trade. Is there, sticking with the Asia region, are there trades being thrown up by the weakness in the Chinese currency? Are there Asia currencies where economies are benefiting from supply chain optionality, for example, from Western companies?
I think some of that will happen, but that's a medium-term trade. I think in the first instance, what is more important is that the CNY is very much an anchor currency in the region. If we see dollar CNY move higher, a lot of regional currencies are not going to want to become uncompetitive relative to that anchor. And so I think the first instance, I think what you will tend to see is you'll see a kind of broader weakening in Asian currencies. Probably some of the more, large islands of domestic demand, places like India, Philippines, etc. Those are probably going to outperform in that sort of environment. But more broadly, I'd expect to see a general weakening in Asian currencies.
9 days until Christmas. More surprises between now and then? We've got a Fed meeting. Would a hawkish Fed be a surprise? Would a dovish BOJ? Would a hawkish BOJ be a surprise?
I think given the fact that the pricing in the Fed has cemented around the 25 basis point cut, I think a lot of the focus is going to be on the path forward, what the projections tell you. We think they're probably still going to show 3 cuts, next year in the median projection.
That sounds more dovish than maybe the market is thinking.
Yeah, I think so. And I think there's probably the market is, we think there's going to be more two-sided risk to the policy agenda that's coming up than the market has penciled in. But if you ask me, I would say, in my mind, I think the scope for a surprise is probably more from the BOJ. If they hike this week, I think that will be a surprise. I mean, we are expecting them to go in January. We think they'll wait to get a little bit more data on the wage negotiation process. But it's a close call.
Wouldn't the surprise be a dovish signal, in as much as the market's not very short going into this?
It's less short, certainly, certainly less short yen going into this than it has been going into previous meetings.
Yeah.
That's fair. But I think that, they have indicated, and I think they do want to move more gradually. And I think where the real surprise is going to be is less about whether it's December or January. I expect that they will move and keep raising rates on a more sustained basis than the market expects. So I think the market expects a pretty short cycle of hikes. We think this is going to go on for longer, but more gradually than the market expects.
When it comes to that, I guess I'm trying to work it all out in terms of the dollar story and the dislocations there, because I think one of the kind of dollar weaknesses, or the arguments for dollar weakness that you're hearing from some of your peers, actually, at some of the other banks, has been this idea that the Trump tariffs will eventually kind of come back to haunt the United States in the long term. but the market isn't positioning that. And I'm curious if that creates a big kind of hole or almost shakedown in the dollar market. And as a result, the Treasury market as well. Is that a real risk, especially in the context of the deficit?
I think volatility is a real risk. I think one of the things you are going to see is that FX volatility, which has been pretty subdued for a while, is going to pick up quite meaningfully as a result, as people try to price out what those policies mean. The reality is we think the dollar is going to remain stronger for longer. Trump policies, when you think about the tariffs, when you think about the deregulation agenda, when you think about the tax cuts, these are strong dollar policies. But what is also true is that some extent of this is priced, and there are some indications that, some of the key protagonists here don't like a stronger dollar, and they're probably going to say that over the course of the year. So I think you are going to see lots of volatility in the dollar. But ultimately, I think if the policy agenda that we've been talking about, the policy agenda they've been talking about is followed, I think you're likely to see a stronger dollar.
And if we see that dollar strength, I mean, does something break? If we see it over a prolonged period, we've seen it already, of course, but if we see it over a prolonged period, does something break? I'm thinking about emerging markets and debt burdens, dollar denominated, if that's something we need to watch this time around.
I think it's something you always have to watch, and I think it's something that, you could see, parts of emerging market pockets, particularly of the more distressed credits, have some trouble, get into some issues. But the reality has actually been that through this dollar higher cycle, emerging markets have coped with things pretty well. I think part of that is their own fundamentals. They've been getting them into better shape. And so, if you think about the year bygone, actually some of the tightening in credit spreads that you've seen, the biggest tightening has been in the most distressed credit story. So you've actually seen quite a lot of value there that has compressed.
How do the Brazilians control the real? It's going down pretty fast at the moment. Saw intervention Friday.
I think the real is probably one of the most interesting stories in global FX right now. I think that, the fiscal package was underwhelming. It was delivered in a pretty disappointing fashion. But I think you have seen the Copom step up. The central bank now has hiked rates meaningfully. They've guided they're going to do more and do more forcefully. And we are seeing the real rate differential now with the U.S. go above the long-term average. That's typically the point at which the currency starts to stabilize. I mean, this is now a pretty punitive short from a carry standpoint. And so I think the fact that that carry is going to move up over the next couple of months, I think that's going to stabilize the currency. Now, there's only so much the central bank can do if the real concern that investors have is around fiscal dominance. Exactly. It's important that the fiscal policy steps up. It starts to move in a more supportive direction, which means starts to indicate a tightening down on the horizon. But I think for now, the risks around that remain pretty two-sided. But I do take some comfort that you've had the central bank that smelt the coffee, that started to move. And I think that should provide investors with an opportunity to earn some carry returns.
I think we've hit almost every currency in this segment, except for Bitcoin. You are, of course, the head of the FX strategy. I have to ask here, we're looking at 105,000 this morning. How seriously are you taking Bitcoin as a real player in some of these FX moves, given that we've been talking about dollar weakness, we've been talking about EMs, we've talked about hedges. Bitcoin has, for a lot of investors, checked a lot of those boxes. Are you taking it seriously in terms of capital flows?
I mean, it's not an asset that I cover in my purview, but there clearly are more buyers than sellers right now, and that seems
safe to say.
Yeah, I think, and that's what's showing up in the price.
Jerome Powell told us it was a currency. Sorry, a commodity. It trades like a commodity, a bit like digital gold.
And I just gave you your get out of jail free card there. Thank you so much. Kamaksha Trivedi will leave the conversation. They're head of global FX, interest rates, and emerging market strategy over at Goldman Sachs. Coming up on the program, Volkswagen's top owner, Porsche Holdings, warns of an impairment of up to 20 billion euros. That and the other stocks to watch next. This is Bloomberg.
Welcome back. We still have 13 minutes to go until the start of cash trading, and we have European equity market futures just slightly suggesting some downside. US futures are flat to positive, but really pretty flat. Waiting for a lot of set-piece events this week. Let's get into a conversation about where we are in markets in 3 minutes. We're joined by our Markets Live executive editor, Mark Cudmore. Mark, let's start with some China data, shall we? Because we see a bit of weakness in the Asia equity session, down 0.3% or so at the time of asking. And one of the contributing factors, perhaps, is the underwhelming nature pressure of the retail sales data out of China? What did you make of that series of data?
It was a terrible set of data, and it comes in the back of another underwhelming set of announcements out of China on the policy side, of where there's very high expectations and then the detail doesn't quite come through. I think that the China story continues to struggle. Now, I push back on the narrative that sometimes Guy has suggested that, you know, the stock market there is doing terribly. The stock market there has done okay this year. Chinese stocks up about 20% this year. Hong Kong stocks up about similarly from about a year ago. Both of them up about 20%. We think that's a great year in any normal year. It's just that compared to US stock markets, compared to mega cap tech in the US, it's terribly underperformance. And the reality is it was terrible until September. All that performance has been delivered on in the last few months. The data this morning emphasised how big a problem they have and how they're going to have to continue trying to address it. And even then, all they're going to do is stabilise the ship. But I think the market story can still be okay, even though the economy will not suddenly boot off into some bull market.
Mark, what's the positioning into the Fed looking like? If we get a hawkish cut, how does the market react? What does the surprise look like from the Fed?
I think there's an expectation here that the Fed has to be pretty optimistic on growth. They can't yet preempt exactly which policies will be delivered by Donald Trump. I thought, Bill Dudley's opinion piece on Friday was excellent about this, talking about the precedent back when he was the vice chair of the Fed at the same time in December 2016 after Trump had won the election, how they factored in the tax cuts because that seemed an easy one and likely, but they couldn't yet do anything on the tariffs, on the immigration or the deportations that might happen. So therefore, the outlook's likely to be optimistic from the Fed. I think there's expectation that it might be, it'll be hawkish to some extent. And therefore, I think the market's going to look through this and dismiss this. I actually think that even though I am suspicious that US exceptionalism can continue throughout 2025, you do not fight it right now. I don't think there are many major catalysts left through to the end of the year, through to 2025, even though we've got the Fed this week. I don't think it's going to derail the story.
Mark, in the context of the United States, can you walk us through kind of the competition for trade and how that shows up in the Chinese yuan, in the Korean won, and of course the Japanese yen as well? Is there a trade-off given the geopolitical headlines we're getting from all three countries?
I mean, between them, yes, but they don't necessarily compete in overlapping goods or services too dramatically. So I think none of them want to get too out of line because they can swivel to some extent. What I think is more interesting on the trade thing that we do not know for next year, not just the level of tariffs that are imposed, but what the reaction function is around the rest of the world. There's a sign this time around that some of US's trade rivals will actually retaliate with their own tariffs, and that will be very damaging.
And we'll see if that shows up in the currency picture. Bloomberg's Markets Live executive editor Mark Cudmore joining us this morning for his Markets in 3 minutes. To get more analysis from him and the team, just type in MLIV GO on your Bloomberg terminals. Go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So Porsche Holdings could potentially face an impairment of up to 20 billion euros on their investment in Volkswagen. As we can see from the screen here, they are the biggest holder of Volkswagen stock by some distance, but Volkswagen is facing financial planning issues, partly due to those ongoing union and trade disruptions we're seeing with the strikes at the moment at the company. As we can see from the screen here, Volkswagen is having a weak year today, as is the investor Porsche. So that one in focus today. Then in terms of Allianz, confirming a few moments ago, a Bloomberg exclusive, that the company is walking away from a deal to buy Income Insurance over in Singapore. Now, this agreement, it was worth around $2 billion according to previous reporting. It did, though, face some government opposition for the deal, and that does seem to be the reason for that breaking down. Year to date, Allianz having a good run, its best run in about a decade, following strength in insurance. Then in terms of home builders, bit of a mixed report out of Rightmove. The numbers in terms of asking prices coming down on a monthly basis, suggesting uncertainty remaining in the market given the mortgage rates remaining pretty high. As we can see, these stocks having another down year. The only positive in the report, though, is the prices did actually come up on a yearly basis, potentially taking the sting out of that. And as we can see from the chart here, we've seen a bit of an easing in mortgage rates since the UK budget, so that's potentially a bit of a silver lining on that one. Then in terms of ratings, Glencore is an outperformer over at BMO Capital this morning. There's a couple of downgrades, SAP in technology, cut at HSBC, and Diploma, an underperformer at RBC this morning.
Thanks, Joe. Our equities reporter, Joe Easton, and he was ending there talking about commodities, at least tangentially, and worth remembering that we saw basic resources, the worst performing sector on Friday. It was a pretty downbeat day for European stocks. That sector was down by 2.3%. Today, we have iron ore prices bouncing in the Asia session, despite weakness in the China data, which could overrule all of that, of course.
Luxury names, how do they respond to a weak Chinese retail sales story? How much is in the price already? What's the expectation?
Yeah.
There does seem to be some belief, at least building within luxury, that maybe you do get some sort of a bounce in China, or is the United States actually the real story now, and we're looking the wrong way when we think about luxury in China?
I mean, maybe, but you're already seeing that, to your point, reflected in CAC futures at the moment, down about almost 0.5%, really underperforming the broader indexes across Europe.
Is that the downgrade? Is that something else? Is that politics? Is that...
I imagine we'll find out when we see the difference on where it's actually getting hit. Because if it's an entire regional thing, then 100%. But to Anna's point, actually, Moody's is doing a little bit of a catch-up here in terms of S&P.
But it was a surprise. I think maybe that's the factor that we didn't... And
if you can't access any ratings at a particular level, then that is material perhaps for some. You know, maybe watch the banking sector.
Yeah, I'm waiting for the read-through on Germany, though. That's the one that's interesting to me. If you're talking about potentially holding on to the debt break, when is that going to show up in the markets? All that is going to be something we talk about in this next hour of programming. We're 5 minutes away from the opening trades across Europe. Futures in the red, France underperforming. The opening trade's up next. This is Bloomberg.
Monday morning, good morning. Let's talk about the context of Friday, and then we can deal with what Monday is going to look like. A little fade early on in the US session. Fairly symmetrical story here in Europe. We go down, and then the US session kind of bounces along the bottom into the close in the United States. Not much of a steer, therefore. A little bit of negativity maybe coming through. Are the events that followed, what happened in France, what's going on over the weekend around the world, going to factor into European thinking this morning? We've got to fold the Chinese data in as well and figure out how that's going to impact the European get-go of trade this morning. But I'm not sure there's much of a steer out of this story, Kriti, into the futures that you're looking at.
A lot of that feels concentrated into one part of Europe, and that is France. And I think that's where you have to kind of zero in here. Futures down by a bigger margin than you're seeing in Eurostock 50 futures, more than the DAX, for example, down 0.5%. Anna, that has to do, of course, as Guy was saying, with that surprise downgrade coming out of Moody's Friday night, the China read-through as well, not to mention perhaps some jitters around the new Prime Minister's meeting with Marine Le Pen today.
Yeah, we'll certainly focus in on the French politics, the German politics, a lot of that to keep us busy through the day. Let's have a look at some individual names that could be on the move. Volkswagen and the German auto sector in focus. We've seen stalled labour talks. Volkswagen and their unions, they seem to be deadlocked on cost cutting and on factory closures or the prospect of that. We're looking at Allianz in the insurance space. They've confirmed that they are not now pursuing a bid for income insurance, which was a Singapore-based business they had been after, but the Singapore government has expressed some opinions not being favourable to that, and so they've pulled that bid. And we're watching the real estate stocks in London, sorry, in the UK as well. UK December house prices falling 1.7%. So says Rightmove, Guy.
Let's take a look at how this market open is going to look this Monday morning. This is the story. Time for the opening trade. Let's show you some numbers. Let's get an idea of what is going on. Expecting the FTSE to fall just a little bit at the open of trade this morning. It's exactly what we're getting. Not a big move to the downside. Keep an eye on the miners. We're going to watch what the CAC does this morning. I think, as Kriti says, that's probably the most interesting market. We are looking at the luxury story. That's going to be China affected, but there's a Bitcoin element in there as well. Bitcoin at a record. Does that read through into the luxury sector? Then, of course, you've got the French political story plus the downgrade to fold into that market as well. Stoxx 600 is doing absolutely nothing. IBEX is doing absolutely nothing. So the CAC's going to be the epicenter of the action. But as Anna was saying, there's plenty of actually interesting stock stories in Germany today. Keep an eye on this VW story. What Porsche is saying about valuations. What's happening with the union story there. That's going to be interesting. I suspect it could take a little while for the DAX and the CAC here on to open up this morning. Kriti, what are we watching as we wait for those two key markets?
Well, you're definitely seeing underperformance in France, which is exactly what we saw in the futures picture. You're seeing a lot of it concentrated in luxury, but it's not just luxury. It's in some of the commodities names as well, which Anna had mentioned might be a China read-through as well. But the outperformance is coming from a little bit of biotech and a little bit of regular tech and a little bit of mining. So I'm a little bit confused with kind of this breakdown that we're seeing this morning.
Yeah, interesting. Just diving deeper into one of the sectors that was not doing so well, which is the leisure sector, and it is leisure rather than travel that seems to be weighing. So Entain, one of the gambling businesses, dropping by more than 5%. Australia starting civil penalty proceedings against that particular business. So where regulators meet up against that particular sector in focus today, and that seems to be weighing on that sector. But yeah, luxury and consumer products and services does seem to be another sector that's under pressure today.
Yeah, LVMH, the biggest points loser on the CAC 40 this morning. It's down by 1%. Hermès is also down. L'Oreal is losing some ground. So, yeah, I think that probably fits the narrative. I'm just trying to see if there's any kind of movement in the French banks, though, on the back of this downgrade. There doesn't seem to be a great deal. Like BNP Paribas is fairly stable at the moment, as is Agricole. Not big moves coming through there. So maybe not that big a read-through coming through from the surprise downgrade by Moody's.
Yeah, and again, we'll have to see how that all shakes out. I feel like we should just go to an expert who's probably tracking this probably more substantially than we are. Helen Jewell, EMEA's CIO for Fundamental Equities over at BlackRock, joining us around the table this morning. One of the big conversations we've had in the last couple of weeks is what is the China playbook into Europe, especially at a time when some of these luxury brands are repivoting away from China into the United States. How do you play China through Europe? Is it still via French luxury?
Yeah, I mean, that is the main way to play it. And always good to be here to talk about what is the key topic that certainly we're talking about both back in the office and also with clients. It is the main thing, but there are two things that really go on within this. You've got the direct impact on the earnings of the China play into the luxury goods. And then you've got the sentiment side. And the sentiment is the most difficult thing to really, A, understand and B, put into valuations. But we're really seeing it actually having quite a big impact on a large number of moves, particularly in Europe at the moment. Both Europe as a whole, but also the different parts within Europe as well. So, you know, the interesting thing listening there about the CAC is that you've got the component parts, luxury obviously being a big part of that. But then you've got this other element, which is the sentiment people feel around the French market as a whole. And the interaction between those two things is actually quite difficult for us to really figure out, because the earnings are definitely moving away from China. There is definitely this focus on the US, and I think a lot of people forget how much of the earnings come from the US. And you've already talked this morning about the strength of the dollar, which really helps those companies which are euro-denominated. But unfortunately, you've got this counterplay with the sentiment, particularly the sentiment for a particular country, which definitely plays against those stocks on any given day, even if in the long term, the earnings are always what comes through.
So you talk about the jitters around France as well. Does that same logic apply to Germany, especially when there's an election coming up, February 23rd? We have a no confidence vote today. Yeah. And yet the stability around Germany feels less scary than France, despite some of the same dynamics at play.
Yeah, no, it does apply to Germany as well. The key difference there is, firstly, the stability seems a little bit greater. And secondly, it's what are the component parts of the individual index. The DAX has had a really, really good run in the last few months. And a lot of that is linked to those constituent parts, the strength of the industrials within them. They've obviously also got that, you know, very, very large company which benefits from the technology play. So that is a real benefit from the DAX. So it's all about that component parts. And unfortunately, what France has got at the moment is the luxury goods, where people are feeling a little bit jittery anyway about luxury goods, and therefore the component part can't do enough to outweigh the jitters. And on top of that, the jitters around France are certainly greater than the jitters. That's a word I didn't think I'd use so frequently on a Monday morning. No. The jitters around Germany at the moment. I'm
trying to continue some sort of joke around jitters, but I can't think of one quickly enough. In terms of where... Are we at peak pessimism when it comes to Europe? Is this as bad as it gets, or does it get worse?
I'd like to think we are. I mean, there's no doubt I would love to come back in 2025 and we see that valuation gap narrowing, but I don't think we are. Because it's this sentiment part that just continues to push the US higher and higher and continues to see that valuation gap increase. And what do people look at? They look at returns, and returns are driven by two things, earnings growth and the multiple. And earnings are going to be higher in the US. They've got those really well-placed companies. And therefore, the multiple will need to do a lot in order to kind of stop the returns in the US being higher. And I don't see the sentiment at the moment doing anything to narrow that valuation gap that is now close to 50%, actually. I mean, it's 45 or so. Historically, it's been around 25. It will reverse at some point. And the DAX, the IBEX, reminds people you can't completely ignore Europe. And Europe has got some phenomenal companies within it.
Yep.
It will reverse. Is it going to happen soon? Are we at peak valuation gap? I don't think so. Now, before you ask me, I don't know what valuation gap we'll get to. I don't know whether it will be 50%. It will reverse at some point. It feels like the growth value story we talked about for 10 years in the past.
If the US rolls over, if the equity market takes a hit in the United States, is that the point at which that narrows, or does Europe actually take an even bigger hit? The US sneezes, the rest of us catch a cold. In that scenario, is that good for Europe or bad for Europe?
So it's good for the valuation gap, but it's bad for Europe. So I do think the valuation gap would narrow. So in essence, that the US would go down by more than Europe. And that's because the positioning is so strong in the US. And again, you see that day in, day out last week. You see a day where you see a momentum reversal, and the US can actually pivot quite a lot in a given day because the positioning is so strong. So if the US sneezes, that is an enormous sneeze. But the rest of the world will catch a cold. So I think you will see the valuation gap narrow, but unfortunately both markets would end up going down. And the question is there a way for that valuation gap to narrow without that happening? And I think the only thing that would cause that is simply the passage of time. And as though therefore, it almost feels like the best thing that could happen to the equity markets is that the valuation gap does continue, even possibly gets wider, and then just naturally narrows because, you know, portfolio dispersion and diversification means that more people just have to rotate out of the US. The positioning has got too great. But that is just a passage of time. So I think if the US sneezes, the valuation gap will narrow, but it's not necessarily the outcome that would be good for any of us around this table.
Big sneeze.
A big sneeze.
Yeah, get out of the way of that one. We've all lived through the pandemic. Helen, let me ask you about... so you're talking there about investing geographically, I suppose. I mean, what about thematically? Is there anything in Europe that will get a boost as a result of themes such as electrification, data centres, all of those things? Are you focused there at all?
Exactly. I mean, they're the two big themes that we have to focus on at the moment. The first is the industrial space. And then the second is these luxury goods. It's effectively those companies that you simply can't really access in the same way in the US. There are some industrial companies in Europe that basically provide things that you can't see in a lot of US companies. The luxury goods names, the benefit they have is they are providing something that no US company has yet been able to compete with. And add to that, the other big theme that we're really focused on is these European exporters, again, remembering those numbers. Everyone focuses on China and that 8% in China, but it's almost a third into the US, and the dollar continues to strengthen. And, you know, listening this morning, it's not something anyone seems to reverse. It seems to see reversing. So the two key areas of theme, we're still very focused on the transition. AI continues to dominate, but of course that tends to be more of a US theme. But what does Europe provide that you can't get elsewhere? But the most important thing, Anna, I think, is that you see the IBEX, you see DAX, you saw China, you saw it in the FTSE as well. You see these indexes that actually have performed well this year, some of them more than the S&P equal weighted, and therefore you shouldn't ignore them completely. Great companies, strong indexes, don't ignore Europe. And I worry that people have because of the US exceptionalism discussion.
Yes, and there's a lot of focus on tariffs that will be coming for Europe, probably, possibly under another Trump administration. But how vulnerable is luxury to that? Because on the one hand, you know, they might be able to counter some of it by weakness in the euro, might do some of the job. And these aren't very price-sensitive products anyway. So should we worry about tariffs when it comes to luxury?
No, I mean, that's not the area that we're worried about when it comes to luxury. The areas, of course, are those areas that are much more likely to see Trump say, you know, we don't need that coming into the US. Autos, of course, is a space that is particularly vulnerable in that area, and that is an area that we still, no matter where valuations are, we still don't necessarily see real value in there. So not really within the luxury space. You've got the euro strength. The one area that we are more concerned about, that perhaps we've not talked about, is inflation and the impact of tariffs, not necessarily on the particular sectors, but what it does to inflation. And if inflation remains sticky, interesting, we obviously got the Bank of England this week, you know, if it remains a little bit stickier than I think we'd all anticipated, that the markets had certainly anticipated, and if tariffs create inflationary stickiness, that would be more of a concern for all sectors, but luxury is a sector that doesn't necessarily do particularly well there.
Lagarde, Christine Lagarde, making that exact point right now. She's speaking, saying risk around inflation two-sided, repeating a line that we got from last week. But even the ECB voicing some concern. Helen, great to see you. Have a very happy Christmas.
Likewise.
We'll see you in the new year. 2025, coming rapidly. Helen Jewell, EMEA, CIO for Fundamental Equities, joining us from BlackRock. This is what the Core 6 looks like. Quick look at some of the major stocks in Europe to give us a guide as to what is happening. Weakness continues in Nestlé. Look at the right-hand side there. LVMH certainly under pressure. That's been the narrative we've just been talking about. Some of the chip stocks as well under pressure. Novo, though, providing some respite on the other side. Big investment into a new factory, maybe resolving some of its issues around supply. That's what the Core 6 looks like. Let's talk some individual names. Joe, welcome back.
Thank you, guys. So we have got Porsche slipping today in Germany, falling 1.4% at the moment on news of a potential impairment of up to 20 billion euros. The low end of the estimate was around 7 billion, but that is hitting that stock amid concern around the trade union disruption at Volkswagen at the moment. Then in terms of Entain, that is the worst performing stock on the Stoxx 600. Anna was running through those headlines earlier, facing potential concerns in Australia around anti-money laundering regulations. The company says it is looking into this and will respond with a further statement on that one. Then in terms of GetLink, the earnings downgrades are set to come in for the company due to disruption on a massive power cable that runs between the UK and France that has been shut down. It runs through the Channel Tunnel. That one's slipping today in terms of the French market. Then in terms of UK home builders, seeing a bit of weakness there. That's as the monthly pricing comes down. The asking prices, according to Rightmove, that data showing a 1.4% decline. We're seeing Barratt, Berkeley, Persimmon, all of those big names slipping this morning. Then in terms of rating changes, SAP, that one recently hit a record high, and HSBC reckons that the run has gone too far today, so they downgrade that, having been a long-term buyer on the stock in terms of SAP. And then finally, another one caught my eye was Diploma here in the UK, the big engineering company. Its only sell equivalent rating as RBC cuts that one to underperform. It's had a good run, and Diploma declining 1.1% in London this morning.
Joe, thank you. Joe Easton from our equities team, of course, with the latest on those movers this morning. European equity markets then flat to negative, underperformance over in Paris. Coming up on the programme, French PMIs are due in the next few minutes. We will bring you those numbers as they hit the Bloomberg terminal. That's next. This is Bloomberg.
Welcome back. We're getting French PMI data onto the screens right now. The manufacturing number is 41 is a really weak number. 41.9 down from 43.1. French manufacturing is not having a nice time right now. The survey number there, 43. So, yeah, we're in the very low 40s now. But there is a bounce in services. So that goes to 48.2, which is a pickup from 46.9 and above expectations. Takes the comp number to 46.7, which is a little better than anticipated. It's interesting, the line you get through in terms of the commentary, the service sector remains in limbo, according to the commentary. Apart from a brief period about the Summer Olympics, service providers have struggled to generate growth momentum. So is this something that could be sustained? I think is maybe one of the questions around this data. But it certainly has... If you were to have had a downgrade in services and then this big downgrade in manufacturing, this French number would have looked very ugly because the manufacturing picture is not particularly pretty.
No, it's not. But, you know, even as we see that, I think, fourth month of contraction for the services number, you're not seeing the euro even blink an eye off of it. And a 105.07, perhaps waiting for some of the German PMIs we get later. We did see a little bit of compression in the spread, I should mention, between France and Germany. Now you're only seeing, I mean, this is such a marginal move. I can't believe I'm pointing it out. But it's only, the spread is now 1 basis point of an increase as opposed to 2 earlier in the session. But you can see that perhaps the market is still a little bit sensitive in the bond market, but not the currency market. Yeah, indeed. So not much overall movement on the back of that data, bouncing off a low base, certainly on that manufacturing story, even if there is some more positivity on services. It was interesting, Valerie was talking about the services side and how that was the area we were looking for improvements, whether that sticks. Yeah, the French bond yields, just looking at that right now, and actually just flat now. There had been some movement earlier on. That's pretty flat. We see yields elsewhere in Europe coming down just a little bit. But she was making this point that, Valerie was making this point earlier, that
a lot of this is being driven by, or last week, at the end of last week, was driven by treasuries rather than the European dynamics, which we rightly pay attention to.
And I imagine a part of that kind of France story is going to be what's happening in China as well. When we're talking about that weaker consumption story, we certainly got that data today. Let's kind of dive into that a little bit because it's kind of seeing maybe a little bit of an effect in these markets this morning. China's retail sales growth unexpectedly weakening in November despite signs of improvement in the housing market. The data highlighting the urgency for Beijing to further encourage residents to spend. Spend on what? Perhaps luxury. Let's get more with Andrea Felsted from Bloomberg Opinion. Andrea, walk us through the story here. I mean, we just had a conversation from a market's perspective about whether you play China through the luxury space. At the same time, we're talking about luxury pivoting away from China. How viable is that?
What I'm told in China is for luxury, it's not getting any worse, but it's not getting any better. There is hope China will come back next year. In the meantime, they're all focusing on the US. The US is now the big hope for the luxury
How good is it?
brands.
Because what I'm hearing is people are spending money in a fairly substantial way.
Exactly. Now, what seems to have happened is since the election, there seems to have been some sort of ending of the uncertain. You know, not everyone's going to be happy about the result, but at least you have a result. It's not a contested result. Market's been good. You've got Bitcoin on a tear. The chat is that has helped luxury sales. Watches of Switzerland were saying since the election they've had some really big spenders come in. They're buying expensive, limited edition, exclusive pieces. The watch market hasn't really improved, but it's not getting any worse. It's sort of bumping along the bottom. Had a really good October, actually. The November weakened a bit. The hope is that that US luxury consumer picks up the bling baton until China is ready to spend again.
What does the bling baton
The
look
bling
like?
baton is very bling. It sounds
It's
very
very bling.
shiny, sparkly.
This has been happening for the last few years. I'd say like the last 3 years. So obviously before the pandemic, China was racing away on luxury. Then, you know, we had COVID, various lockdowns. And while that happened, the US consumer picked up slack. Stimulus payments, cryptos, markets. They all bought Rolex watches, Gucci handbags. Now, then that really slowed. And for a while last year, China bounced back. You know, when we had that reopening trade, that's fizzled out. And for a while last year, we had both of them in the doldrums, which was, you know, why we saw those, you know, quite weak numbers, even from LVMH. Now, the hope is that the US improves, and that takes up the slack until China improves.
Would I be right to assume that the Bitcoin consumer is quite a bling consumer, Andrea?
Yes. It will probably take a bit of time. Now, definitely was last time, because lots of people are sitting at home trading. I was told that this time it's a bit more mixed between the day traders and the institutions. But, you know, you've got, you know...
Andrea Felsted is becoming a Bitcoin expert.
Well, all the things you can buy with it.
Only through luxury. You know, the US luxury market is correlated to stock markets. Stock markets have been very good. You've got the extra oomph from Bitcoin. So they're all pinning the hopes on the US this year. Whether that happens, whether the jobs market weakens and takes a bit of that away, that's the big unknown. Tariffs.
It's quite amazing that we haven't seen, you know, you describe the US as just sort of bumping along rather than really taking off. When stocks and risk assets have done as well as they have, that's almost makes me feel more gloomy.
No, there's two reasons for that. The first is we had that luxury, you know, we had that real luxury boom when everybody bought things. You know, perhaps they didn't need to come back and buy again so quickly. We also had the huge price rises. HSBC tracks a sort of basket of iconic luxury goods, Chanel handbags, Moncler coats. They've gone up by 54% since 2019. That has priced out a lot of those consumers who were spending their stimulus. Plus, a lot of the wealth has accrued to the older generation, whereas the luxury consumer is getting younger.
Andrea, thank you very much. Andrea Felsted from Bloomberg Opinion. Let us go over to Lithuania, to Vilnius. ECB President Christine Lagarde is speaking at the annual economics conference in Vilnius, marking nearly 10 years of the euro in that country. Let's listen.
Messieurs les gouverneurs actuels ou anciens, messieurs les membres des conseils divers et variés, monsieur le président du conseil de la Banque nationale de Lituanie, and now I'll switch to English. But it was also my way of showing my huge respect for those in the audience, and in particular to my host, Monsieur le Président, and to you, Gediminas. Thank you so much for having me and thank you so much for hosting this conference. It's a true honor to be here. And although you gave me a slight reminder of what I looked like 10 years ago, which was a lot better than what it is today, but at least, as some writers have said, I survived. And you have more than survived. You have thrived. So, Laisve, Fienibe, Gerove. To those who don't applaud because they don't know what I said, it was freedom, unity, and well-being. And these are core national values of Lithuania. And accordingly, they are engraved on the edge of your €2 coin. Freedom, because of the liberation from Soviet occupation. Monsieur le Président, you reminded me of this March for Peace that brought together more than 2 million people. Unity, because of the need for national solidarity, and well-being, expressing hope for economic and social prosperity, which, Gediminas, you have beautifully showed us through the charts. These three words capture the spirit of the Lithuanian people. And I believe that being part of the euro has actually strengthened those values. Let me briefly say in which way. The country is now an equal partner in setting monetary policy for one of the world's most important central banks, rather than having effectively to import the monetary policy of whoever are the large neighbors. And that gives the country the freedom in charting its own macroeconomic destiny that smaller economies cannot otherwise typically claim. Lithuania also now issues the world's second most important reserve and invoicing currency. That provides unity in the face of a more volatile world, as foreign shocks do not penetrate the domestic economy as much, owing to domestic currency invoicing. It was clearly the symbol of
Christine Lagarde speaking there in Vilnius in Lithuania, 10 years since that country joined the euro. More widely, though, some of the lines she's going to be delivering. Risks around inflation are two-sided. We heard that earlier on. More ECB rate cuts are expected if the baseline holds. The direction of travel is clear on monetary policy. Just a couple of the lines that stood out from her speech this morning.
She's also talking about the wage tracker seeing a drop to about 3% in 2025 versus 4.8% in 2024. She's telegraphing, Guy, this idea that they're ready to cut interest rate, a completely different communication strategy than what you saw with Jay Powell.
Yep, coming up on the programme, we will stick with the European growth story, but talk about Germany. Our next guest believes Germany is in a structural slump, decades, though, in the making. We will get to our conversation with the author Wolfgang Munchau. That conversation coming up next. This is Bloomberg.
This is the opening trade. We're at 30 minutes into today's session. We are already seeing movement on the German Bund yield here as the PMIs drop across the Bloomberg terminal. December services rising to about 51 versus 49.3 in November. So actually a little bit slight. Very, very slight expansionary territory there. The manufacturing remains the pain point, down to about 42.5 rating versus a 43 in November's data as well. This is important to keep in mind that this is also not really moving the euro that much. A slight tick higher that we saw, Anna, but not a big one in terms of sensitivity, which I think we were expecting, given that in the equity market, you start to see a little bit of catch up in terms of underperformance from the DAX relative to the CAC.
It is interesting how we do see this rebound then in services a little bit, and at least it is back into something. It's back in expansion territory in the eurozone in the shape of German services, but that manufacturing just underscoring the weakness in that sector once again. Let's bring in Bloomberg's Oliver Crook, who is at the Bundestag in Berlin for us. Ollie, you've had a look at this data. Take us through your thoughts.
Yeah, so listen, I mean, it's nice to see that services have bounced back a little bit. Obviously, the pain point for a very long time in the German economy has been manufacturing. It's good to see the services. Of course, last month, they unexpectedly contracted quite dramatically, dragging the entire sort of complex into contraction territory. That is positive. However, what is not so positive is I just have these sort of looking ahead, the surveys of businesses from IFO looking at 2025. And here it makes for fairly grim reading. IFO says that only 1 in 8 companies in Germany expect better business next year. A third of them expect business to basically deteriorate. More than half basically think it's going to stay more or less the same. And basically this is consistent across basically all sectors of the economy. Construction is probably the weakest, with only about 5% of the companies there expecting any kind of improvement. But you see it across manufacturing. You're seeing it also in the services sector. So while you have the backward-looking data here for the services, a little bit of growth in Germany. Looking into 2025, according to the IFO, again, these are surveys across all different kinds of companies, looking very, very negative, frankly, into next year.
I'm just reading the commentary coming through from market on the data. It looks like the German service sector is setting up for a better than expected Christmas season. I'm trying to provide some Christmas cheer here going into what appears to be a fairly gloomy period for Germany. Let's talk about what is going to happen a little bit later. The building behind you, we're going to get this confidence vote. This is largely procedural. Yep. We are effectively getting the dissolution of the German government today. In terms of what comes next, we're going to hear from Merz a little bit later on. We're trying to understand where the CDU-CSU stands on the debt brake, because we're getting quite conflicting signals. Ollie, can you clear this up for us?
Yeah, absolutely. I mean, listen, the signals that we were getting from Merz was basically a sort of indication that there might be some openness to talking about reforming the debt brake. I've couched that in quite a few terms, but that was basically the idea that the CDU, which is, of course, the party that brought the debt brake, not just as a law, but remember, this is part of the Constitution as of 2009, so this requires 2/3 of the Bundestag in order to basically change. And with this sort of collection at the Bundestag, where you have some more disruptive parties, like the AfD, expected to take about 1/5 of the vote, it might be very difficult to do that. The question was, does the CDU have some political will to do that? The indication was that maybe. Now we have seen the sort of draft of their platform that they're going to put out ahead of the election in terms of what their recipes are, and it seems that they basically backtracked on this notion, saying that basically they're going to stick to the debt brake. And just as a reminder, you know, this restricts borrowing in Germany to 0.35% of GDP. The Greens and the SPD have been against the debt brake and are saying it needs basically radical reform, particularly when you're competing against the likes of China with a lot of state-backed enterprise, and the United States with the Inflation Reduction Act. Robert Habeck, the economy minister, leader of the Greens, has likened this to Germany basically boxing with its hands tied behind its back. And, you know, when you think about the platforms that the CDU and CSU are presenting, it's a lot of the sort of classic formulas of just cutting taxes, cutting bureaucracy, these sorts of things. Maybe not the huge shot in the arm that, frankly, potentially this German economy needs in order to remain competitive and really get back on track.
Ollie, today's debt are tomorrow's taxes. That's the commentary, of course, coming out of the CDU that you're referencing. It's also the pain point that kicked off what is expected to be today's no confidence vote. Walk us through the next 24 hours.
Yeah, so listen, this all began on November the 6th, really hours after Donald Trump got elected, and basically Scholz fired the finance minister. Last week, he asked for this no confidence vote to be held. That will be held in the building behind me a little bit later today at 1 p.m. This all begins. Scholz will give a 25-minute speech in front of lawmakers. That will then be followed by a 2-hour debate, then followed by this sort of roll call vote, and we get the outcome at about 4 p.m. local time, 3 p.m. London, where we're expecting basically there be a motion of no confidence in the government. Then Scholz goes to the president, Frank Steinmeier, and basically dissolves the government and really paves the path for that February 23rd election, in which, you know, over the next couple of months we may see things evolve, but really the CDU as the #1 party with 31%, the AfD with #2, and then the SPD really closing the gap just a little bit, making the most likely outcome at this stage a kind of grand coalition CDU, SPD, which is a sort of configuration we've seen a lot in German politics over the years.
Ollie Crook, outside the Bundestag in Berlin for us. Thank you very much indeed. Let's carry on the conversation. Where does Germany go from here? Wolfgang Munchau, the author of Kaput, joining us around the table, The End of the German Miracle, the book that effectively chronicles the arc of German decline over the last few decades. Are we maybe reaching the bottom? Are we starting to get anywhere near peak German pessimism? Wolfgang, here to answer that question. Good morning.
Good morning.
Nice read. You kind of track so many different angles as to how we've got to where we are now throughout the book. Where we are now, though, as I say, is this as bad as it gets, or do you think we've yet to fully understand and therefore resolve where Germany goes next?
You quoted the IFO index or the IFO survey, and companies expect things to get worse. So we've seen the PMIs go down, but this is just the cyclical stuff. But this is a structural slump that is happening in Germany. So this is, people are treating this very much as a cyclical crisis. But this is, this has been going on. Essentially, the decline of industry started at around the time of Brexit. And it continued. It went through the pandemic, and then it didn't recover after the pandemic, and things got progressively worse. This is Germany. This is a crisis of Germany's business model. This isn't just a crisis of economic policy. This isn't just the debt break.
Yep.
Even a debt break reform, which I think will happen, not a big one, but a small one, will not fix the problem.
You make the point throughout the book that Germany still wants to go back to the industrial model that it had, the one that worked so well post-war, 60s, 70s, 80s, 90s, it delivered for Germany. And there seems to be this belief that you can still go back to that model. That paradigm still exists.
Absolutely. That paradigm is still dominant amidst all the political parties. So you don't see any sort of debate about this. It's all about how to manage the 20th century economy better. It's all about, engineering. It's all about, heavy industry. When Scholz invites industrialists to a summit in his office, it's usually the car industry, the chemical industry, and the steel industry.
Yep.
They never talk about the digital economy. They don't talk about AI. Nobody in Berlin talks about quantum computing.
Yeah.
Heaven forbid. It's just something
is
that
a
is
German
not
word for AI.
It's very long, I'm sure.
There is, and it's very long. No, it's actually not that long. But it is
longer than AI.
It's certainly longer than AI. That's for sure. But it's ultimately, not something that is on the forefront. I mean, industry is talking about it increasingly because it affects industry. It affects quality control and various things they can do. But Germany is behind the times on all of these things. It's one of the least digitalized economies in Europe. It's got one of the worst mobile phone networks in Europe. People don't know this about Germany. They think of Germany as being sort of high tech and that is, that's true for the engineering tech, but it's not true for digital. And digital is starting to encroach on engineering products like cars. They become increasingly digital. The self-driving car is predominantly a software product, not a machine anymore, not a driving machine.
Certainly a lot of chips in there. We caught up recently with the former ECB President Jean-Claude Trichet, Wolfgang, and we were asking him about Germany and all the things that ail Germany. Let's have a listen to his summary.
They are hit by three considerations that are very, very, I would say, profound and demanding. First, they had subcontracted their energy to Russia, doesn't work. They have subcontracted their trade to China. So security is totally subcontracted to the US, which is also, I hope not, but also a potential problem.
Trichet with the three things that he thinks Germany has subcontracted: energy, growth and security. Do you see any signs of a serious grappling with those? I mean, the energy regime has changed a lot and, a lot more importing of LNG instead. Really serious security considerations. I mean, do we give credit for these things? These conversations have evolved a lot in Berlin in recent years.
They have. Energy had to change because the gas flows from Russia stopped. And they've now replaced it with LNG flows. But they still switched off the nuclear power after the gas flow stopped. And that was a critical mistake. The nuclear power, when they came to power, this government that's about to be, that's about to be officially ended today, when they came to power, nuclear power accounted for 14% of the energy needs of the country. Now, that's not most of it, but it's still something you would probably not want to just give up on when you have a broader energy crisis. The export dependency to China is very critical.
Yeah.
China used to be sort of nice complementary with Germany. Germany produced machines and China produced consumer goods. Now China is competing with German products like cars. China is out-competing the German car industry. So this is now no longer be a viable business. And for security, I completely agree with Jean-Claude Trichet. Germany has been, has overspent the peace dividend. They will struggle to get back to 2% because they only got back to 2% because of a one-off spending package. That's going to run out next year, so they'll have to actually make available 30 billion euros just to get back to 2%, whilst NATO is talking about 3%.
And so then let me ask you about the debt brake, because you mentioned that maybe they will tweak it, which is interesting because a lot of our conversations get too binary on this subject. Will there be one or will there not be one? I mean, the fact that the Germans like to have one, maybe we just accept that that's something that Germany likes to have, but that doesn't dictate where the limit has to be.
That's right, and that's also how I see the CDU's sort of manifesto pledge about not reforming it. There will be things they will accept. For example, one of the recognized weaknesses of the debt brake is that investment has been, that government saved money by cutting out investments, because investments scream the least loudest when you save money in a budget. So Germany and other European countries saved on investments and with dramatic consequences in the long run. Now they might ring fence this, but they might keep the overall macro balance. They might introduce a reform that when the debt to GDP ratio falls below 60%, that this would give them additional flexibility. At the moment it's 63%, so at the moment this would not do anything. But it could make a change in 3 or 4 years. So I think the debt brake will be reformed. You're absolutely right, it's not binary. Absolutely. This is not going to be binary. There are hundreds of ways to reform it. And I think the way the consensus is evolving, especially with the CDU in the driving seat, I think it will be a reform, but it will be cautious. It will be one that will benefit the lender, the states. It will be one that will ring-fence investment. But I don't think it will be very adventurous as far as the overall fiscal balance is concerned. So people, I think, are overestimating what it will do.
Well, let me plug holes into that. And that it sounds great that if you remove the debt brake, suddenly you get investment to Germany, which they need. It sounds like a very, frankly, simple solution. But doesn't that expose Germany to the issues you're seeing in France and the United States around the deficit? Doesn't it basically create a reason to pull money out of Germany if the implication is that every time Europe chooses to invest and go down that path, they end up a couple years down the road with the slippery slope of these extreme deficits? Why would Germany not follow that path if they remove the debt brake?
If they remove the debt brake, that would exactly what would happen. It's also the reason why they introduced it in the first place. I'm not a big fan of sort of inflexible fiscal rules, and certainly not, that put numbers into the constitution, because numbers change all the time. But the principle of debt sustainability is sound. You're absolutely right to talk about France. France is on a very dangerous slope. They just got a new prime minister. They will struggle to maintain their fiscal adjustment plan. So France will be struggling with debt for a very long time to come, as is Italy. If Germany got rid of the debt brake, the same would happen in Germany. We're all subject to the same political pressures. So a debt brake reform will be, that ring fences investment and that encourages governments not to cut investments but to cut spending. That could actually be a sound compromise and actually a good compromise. But it's not going to. We should be clear. This is an economy that has basically given itself a business model that is becoming increasingly out of date, and the debt brake isn't going to fix this.
I'm sure guys can have more Germany-specific questions for you in just a moment, but I want to ask you about the European project more broadly, because one of the big concerns, you mentioned France, you mentioned Italy, is that if we start to see an even worse situation in Europe, this could be the beginning of the end of the European project. Perhaps some hyperbole, but in your perspective, is there any validity to that argument, given the kind of pivot points that we're at?
I think there's validity to the argument. We should not sort of start here easily predicting, the euro will end, the EU will end. It's not going to happen. If formal disintegration is as hard as integration, because it's all part of our laws and it's highly intertwined. But the way you put this, like the end of the project, I think that is a much more real threat. The danger is not that the EU will collapse, that it will simply cease to become functional. And that is something that I can see. Look, we have Trump in the White House. The EU can, he may impose and probably will impose tariffs. It will have significant impacts on industries already weak. We might retaliate, and that's sort of our, what we will do. But we will not going to, switch to an intelligent policy as a result, which would be, to reduce export dependency and start to balance our economy more than we did in the past.
There's this joke going around in China talking about the fact that Trump's going to be good for their economy because basically he's going to force change. He's going to force the Chinese economy to adapt and deliver in a different direction. Could the same thing happen in Germany? You talk about Trump's tariffs. You can argue that Trump is basically pushing towards something that looks like Plaza. 85, you end up in this kind of scenario where you devalue the dollar. The tariffs are kind of the precursor to all this. Germany needs to be put in a position where it spends. Are there any German Keynesians left? I'm just kind of wondering about that. But basically, you end up in a situation where Germany is forced to spend. You mirror the current account surplus with government spending and a deficit. Is that in any way a plausible argument for Germany to move forward from here, that Trump effectively forces change?
Yeah. I remember I once wrote in a newspaper column that the number of Keynesians in Germany could fit into a single room. And that's basically the case. There is a very, this is not a dominant, shall we say, dominant economic philosophy.
Could Trump force change?
Over time, yes. But what will probably happen is that the way Germany has adjusted, for example, to the fall in Chinese exports, is by importing less. So you can maintain an imbalance by just depriving yourself, by saving even more. There are unhealthy adjustment ways, just as there are healthy adjustment ways. So I agree that China will and should increase consumer spending to rebalance. With Germany, given its dependence on industry and the pessimism in the German economy, I do not see this as a sort of a moment for consumer exuberance. So what I could see could happen if this process is mismanaged, as it most likely will. That the German economy will adjust, say, to a trade shock with the United States by reducing imports further in order to maintain whatever surplus it has. It's really addicted to surpluses, and there is, as yet, no political party in Germany that has a serious focus on this. I mean, the left wants to maintain industry as it is. Yep. The Greens talk about the energy, that's a priority, the energy transition, whereas the CDU drives a competitiveness agenda, which is really about export surpluses, making industry healthy again, what we did in the first decade of the century. Yep. When we've had dramatic social reforms, welfare reforms, to make labor cheaper, to encourage people to go to work, that helped companies to reduce cost, and that was sort of a mechanism to make Germany more competitive, but the products were good. That was a period when the German car was the top-notch engineering product. That is not the case anymore. We have a different problem now.
Good at gearboxes, not at software. Wolfgang, nice to see you. Always a pleasure. Thank you very much. Wolfgang Munchau, author of Kaput, The End of the German Miracle. Coming up, are European equities set for another year in Wall Street shadow? Kind of related subjects. We're going to discuss that next. This is Bloomberg.
This is the opening trades. European equity markets then down 0.2% this morning. A little bit lacklustre this Monday, waiting for a lot of set-piece events this week as we try to bring the year to a close. US futures flat to positive this hour. Now, European stock bulls are looking for the region's equities to close the gap on the US next year. And are they set, though, for disappointment? That is the finding of our survey of strategists. Bloomberg has been doing that survey, and the result's not good for European stock bulls. Let's bring in Bloomberg's Michael Masika, who's got details on all of this. Michael, good to see you this morning. So, from your survey, does it seem as if European equity investors are expecting quite a lot from Europe? And do you think that is misplaced?
Actually, they're expecting nothing from Europe, really. To be perfectly honest with you, this is typical, very cautious outlook on Europe. We've seen that many times over. There's always like the big bulls are out in the US. Very, very strong convictions that the market is going to keep rising. And in Europe, they're like, not so much. The economy is not doing well. European investors prefer US equities. It's just like the conclusion is there's not much downside. Like, no one expects the region to do bad, but no one expects the region to do great either.
So more money just pours into the US. US retail is as long as it's ever been. PMs are as long as they've ever been. They've got money sitting on the sidelines. Does that money come in? Does it just keep going? in the States?
Well, that's a good question, but at the moment, that's what it looks like. You have a region which is still doing better in terms of like economic growth,
sure,
earnings growth. The tech is what everyone is into, and
market's getting narrower, not broader.
Exactly. The broadening was very short-lived, and now we're again like all into big tech, and Europe doesn't have that. I mean, there's two big tech stocks in Europe, SAP and ASML. That's it.
But is there a valuation argument here in that if you start to see enough battering of the European market, it just doesn't make sense not to own it anymore? Is that the tailwind we're waiting for?
Exactly. I mean, the valuation gap has been there for a while.
Yeah.
It's been widening terribly. I think we're like 40% now. But at the same time, there's reasons for it. So the earnings growth is one. The sector split is another. But at the same time, you got to wonder where this is going. So you have a region which is priced for perfection, and everyone is expecting a lot from Trump next year, very business-friendly policies. At the same time, in Europe, it's all priced for like to fail. So we have the political uncertainty, and it's priced to continue. France is a bit of a mess. Germany is going to have election in February. No one knows really what's going to come out of that. But at the same time, you can think, okay, there might be some good surprises that we can have here.
Yeah.
So like it's still the asymmetry of return is really in favor of Europe in that sense.
Yeah.
Because you can have a very good surprise from Germany because they have a lot of money to spend. They could actually, pull out the stimulus bazooka. So we're waiting for that. China is another one. And the policy, of course, the monetary policy.
You paint a picture. I don't know what the picture is exactly. Bloomberg's Michael Mazika joining us around the table this morning, kind of talking about all the different factors that we're going to see. I think you kind of briefly mentioned the monetary policy. We're going to get plenty of that this week as well. We've got the Fed, the BOE, the BOJ, plenty of the stimulus bazooka, potentially.
Any surprises potentially being generated by any of those central banks? We get a hawkish Fed, we get a dovish BOJ. What does the Bank of England do? Actually, I think there's a few... Yeah. There's a bit of potential this week.
Right, yeah, we are expecting a lot of holds, aren't we, actually, in amongst all of this. So two banks expected to cut, the Fed and the Riksbank. The others all expected to hold. So it'll be a focus on the guidance and expectations into 2025, with the key question, with the key fact, of course, that we don't know what Trump's going to do in the White House once he gets in, and all the central banks dealing with that uncertainty.
I wonder what the reaction to the PCE on Friday is, or if everyone's just going to be checked out pre-Christmas. 9
days till Christmas today. By then it'll be less.
And now drinks are on you.
Counting down. Coming up on the programme, don't miss our interview with the European Investment Bank President, Nadia Calvino, joins the conversation at 9:30 a.m. UK time. That's coming up then on The Pulse. That is it for the opening trade. We are looking at European equity markets that are down by 0.2% this morning. US futures still flat to slightly positive. Have a good day, everybody. This is Bloomberg.